Guys, chill. There is nothing to see here. We might have to keep money tight for a while, but there will be a soft landing. This is pretty much in a paraphrased way what Jerome Powell is saying. And what's interesting about this is that the market seems to believe him. Isn't that crazy? Interest rates are at levels we haven't seen for 15 years, but the stock market is super close to its all-time high. And apparently the reason for this is that markets are forward-looking and everybody expects interest rates to come down. This is what's priced in the futures markets. Let's have a look. So the next FOMC meeting will be in 55 days. And there's a very high likelihood of 78% that we simply stay at the current level. And we can extend this out even a bit further. This is what the market is anticipating when looking at the futures, a gradual decline from the current level. When we look at this on a very long-term chart, this is pretty much the anticipation. So that's our current level. And until March of 2026, we should arrive at 3.4%. And so with declining interest rates, asset prices should go up. In fact, asset prices are already up. This is the Nasdaq and it's very, very close to its all-time high. This is the Nasdaq relative to the S&P 500, also very close to its all-time high. In other words, the stock market is really risk on right now, despite currently the interest rates being relatively high. Now, there are two reasons why interest rates have such a big impact on asset prices. A direct reason and an indirect reason. We can see the direct impact in the property market, right? When interest rates go up, then you have to pay more monthly in order to buy a property. You can afford a less house when every month you have to pay more. And so naturally, with rising interest rates, the demand for expensive housing goes down. And if supply stays stable, that means that the prices tend to go down. It's not what we have seen during COVID, because everybody needed more housing in order to work from home. Very few people wanted to sell their house, and so despite lower demand, the supply also went down, so the prices didn't move much. But in general, there is this direct effect. Whenever interest rates are higher, then less investments become profitable, meaning GDP shrink, economic activity shrinks, and asset prices tend to rather decline. But there's also a second reason why asset prices tend to go down, especially the very high risky ones, the growth stocks, for example, whenever interest rates go up. And that second reason is opportunity cost. On a fundamental level, the value of a stock is its sum of its future cash flows. So stocks pay out dividends, and the sum of all of those dividends is in the end what the worth of the stock is. Now, a cash flow you get 10 years in the future or 20 years in the future is worth less to you than the cash flow you get today, right? That's called time preference of money. You've got that time preference because future dollars are worth less, but also because they are less certain. Now, when the return on risk-free government bonds is rising, that means that stocks have to compete with those risk-free bonds. You're discounting the future cash flows more, first depending on how far out they are in the future, but also depending on how high the interest rate is. So say when the risk-free rate is at 5% and your cash flow comes in 20 years, you should discount that cash flow by dividing it by 1.05 to the power of 20. So say in 20 years you expect a dividend of $100, you have divided this by 1.05 to the power of 20. Which means that cash flow in today's money is only worth $37.69. Now let's say the interest rate goes down. Then you would only have to divide that cash flow, say when the interest rate is only 2%, by 1.02 to the power of 20, which is $67.29. So see how the change of interest rates of only 3 percentage points changes the value of this single cash flow 20 years out in the future by like 40% or so. A huge change. And so that means the riskier your investment is, the more you expect the major cash flows to happen far out in the future, which is normally the case for tech stocks, for example, the more they are sensitive to interest rate changes. And that explains why the Nasdaq relative to the S&P 500 is very close to all-time highs as well, because people expect interest rates to come down again, and with that expectation, it's okay to be in tech again. And so paradoxically enough, if we see another global financial crisis, another banking collapse, where the Federal Reserve has to lower interest rates again similar to the GFC, then this could be potentially positive for tech stocks, because those lower interest rates especially benefit technology. If you feel like you have learned something in this video, then feel free to give this a like. And if you haven't yet, you can subscribe as well. There's also a Telegram channel. Simply search for Bitcoin Strategy Channel within the Telegram app or click the link down below. I hang around there regularly, looking very much forward to chatting with you. Bye-bye.